So, the way we have framed this session, and you're welcome to push back against it if you disagree with the framing, is that we all know that, companies ultimately, especially publicly traded companies, right, ones that have to have fiduciary responsibilities, the senior officers are responsible for either quarterly or certainly annual results, and shareholders come banging down the door, and not all activists are climate activists. There are also financial activists that can come and knock on your door to say, why are you wasting my money or my grandma's pension money? And that sometimes can make it much more challenging to accomplish some of the things that a CSO might want to accomplish with ambition. And if you accept that conceit for our session, who wants to kick us off and talk a little bit about how do you engage in a conversation with the finance side of the house and the pressure for short-term results when you're working on such a long-term topic as sustainability? Mm-hmm. Sure. Who wants to lead the way for me? Sure, jump in.
I can kick off. When I started doing this, for us, just a quick intro about Virgin Media O2. So we are a telco operator here in the UK. Big happy merger between O2 and Virgin Media 2 years ago. Provides streaming, broadband, mobile. So that's kind of what we focus on. Certainly we started doing this over 17 years ago. I never thought most of my meetings will be with the finance team and the CFO. But here we are. Definitely, I think a lot of us who are working in the sustainability space have seen the shift between kind of moving on from meeting with NGO partners to meeting with investor relations and finance and the CFOs and their organizations. But at the same time, I think the kind of the evolution of green financing has made it really a good time for CSOs and sustainability practitioners in general to have the right conversations with finance, where the conversation is no longer about how much it's going to cost to transition, but what are the benefits for the business as well in terms of access to capital, in terms of de-risking the strategy, because the instruments have evolved so much within the capital market space that finally we're having conversations that are a lot more strategic. And of course, you're always going to face that short-term, long-term kind of conflict where you're really having to do a lot of education, and you have to take your CFO through a journey to understand that impact takes time, and we're going to have to make some big bets. And getting the company comfortable with that, not that it's easy, but I do think the evolution within the green financing instrument space has helped a little bit with us having conversations around the possibility of actually de-risking ESG strategies.
Can you give a concrete example of one of these instruments that has made a difference in how you think about it or your conversations?
For us, most of our capital is green bonds and sustainability-linked loans. These are the two that we're focusing on. The kind of KPIs we're linking to our green financing, our KPIs, they used to be when we started exploring the green financing space, used to be primarily about refinancing and looking back and kind of dealing with old debt. But now we're actually focusing heavily on forward planning. And so a lot of our KPIs are linked to things like network expansion. Mm-hmm. And how do we make sure our network expansion is green and we're getting rid of brown energy within the network expansion space. That used to be a very different conversation a few years ago when I was at Vodafone, where the conversation was less about how can we make our network greener, and mostly about how we're going to pay for it. And now, thankfully, because of the kind of KPIs we're linking to our green financing, one of which is green transition of our network, we are literally guaranteeing a flow of investment into the transitioning of the network, which wasn't possible a few years ago. So that's kind of a concrete example, at least from the telco side.
Yeah, that's very interesting. So these green financing tools are working for you in your sector. I know in some other sectors, we can get into details as we get into the conversation. It's not as effective, or the companies are not accessing them as well. But it's good to hear a positive report from you. Mm-hmm. I saw you ready to jump in there.
Yes. So, hi everyone, I'm Maggie, rep for Normative. Good support there on the panel, thanks, the giggles. Yeah. And we're from Normative, carbon management platform. And I'm going to make a bold statement. I don't see the relevance or how any CFO or CFO can be relevant currently and in the years to come if this is not a boardroom priority for you.
I agree.
And realistically, if we think about some stats, like over 70% of the companies listed on the FTSE 250, over 70% of those CEOs and CFOs have the meeting of sustainability metrics, usually actually around carbon reduction, as part of their LTIPs plan. And I would say across our customer base, the vast majority, I loved your point, Stella, the vast majority of our customers, they're coming to us already going, we know we have to do this. And for the record, they're not just saying it because, oh, if we don't, the regulator is going to be angry with us. No, they fundamentally understand this is about the future of the businesses and their joint stewardship of the businesses for which they are accountable. Because what we're talking about here, and you can see it in Dana's points, is about the relevance of companies vis-a-vis future access to capital, future ability to attract and retain employees, and the same goes for consumers. I know I could bore you to death with stats around the amount of business benefit that our customer base is enjoying, and also from a CFO perspective. And hands up again, the CFOs or finance professionals in the room? Okay, see, know that money talks. And sustainability, it's not just about meeting some esoteric targets, nor is it about just the supremely important climate imperative. There's also massive cost-saving reduction opportunities to be had here. Like one of our customers, Eltel, was able to significantly reduce their fuel costs, number one, by optimizing drivers' routes using carbon emissions data, and secondly, was able to build the business case to transition the full fleet to electric because of it. So there's these real financial impact that CSOs and CFOs are able to build around this. And the expertise from the CSOs, we see that CSOs are shifting into being change agents within the board. And the
you are a very eloquent and effective advocate for this perspective, but somebody in the audience has a question for you. They want some free advice. Yes. Madam Anonymous says, are there any tips for persuading your stingy CFO that additional investment...
Say stingy now.
When you hear the rest of it, you'll see that the additional investment is worth it when cash flow is stretched in the short term.
Well, you see, that's the kind of question I like, because yes, I'm an advocate, but I'm also, above all else, a businesswoman.
So tell us.
So for me, it has to pay. And I'm the kind of person, I like facts, and I like things being anchored in business imperative. And our customers that are having the most success, and whoever this is, either find me later or virtually, and I'll send you some awesome case studies that will give you the business case metric fuel to pitch to your
give us a sneak preview. How would you answer it in a brief response here?
Well, I prefer real-world examples. So take a customer of ours, Norican. They came to us to get on their net zero journey because their investors had told them they needed to. Number one, access to capital. But secondly, it was fundamentally about their future ability to maintain their relevance in their market segment, because some of their biggest customers had said to them, in order to be able to even engage in the RFI, and let alone the RFP, for contracts, they had to be able to prove their quantifiable, independently verified progress on net zero. So, and that case study, by the way, is live on our website if anyone wants to learn more about it. So that's the one I'd say.
Okay, so she's got a lot of responses. You can check it out on our website or chat with her afterward. That's good to know. David, we're obviously talking about the broader theme about persuading the financially minded folks about the value of these kinds of investments. But you said something to me earlier that was quite interesting. You said your perspective changed today from some of the sessions in the morning that you heard. So see if it's relevant to the answer. But work that in as well. We'd love to hear your reflections on the morning, if how it might have changed your point of view, and bring us home with telling us a little bit about how you talk to CFOs.
Yeah, so I was coming here, guys, prepared to talk to you about what my colleagues just told you about, which is how we create financial value and how we engage into remapping the organization around value delivery. I wanted to talk to you about that, but they did that really well, and I'm not going to repeat the same ideas. In fact, this morning, we had a session about education, how the education sector empowers the workforce to be able to address the climate challenge. And it reminded me that actually the main enabler to allow for the collaboration between the CSO and the CFO is culture. Yeah. We say, culture eats strategy for breakfast. And there is truth in that. So how, you asked the question, how do you engage with our CFO? Well, I engage with him over coffee, over a glass of wine, over a water fountain conversation, because it's about creating that culture and that report, right? It's about understanding what is the common language you can develop with your CFO. It goes further than that. Once we established our governance structure, so the ESG dedicated board in our organization, we are the largest publicly listed retail group in New Zealand. Once we did that, we had to activate the organization around the opportunity of climate action and sustainability. So we created a number of devices to create that culture. It could be around a day of co-designing solutions, where about 1,000 of our team members came together in an open format to co-design using human-centered design techniques to ideate and co-design the actual delivery of sustainability in everything we do. Then we created another device called the Tomorrow Test. And with the Tomorrow Test is a very open question, where we said to our team members, if there is something that doesn't pass the Tomorrow Test, please flag it. And we left the criteria quite open, but what we saw was a disproportionate amount of engagement from every corner of the organization. So the point I'm making to you guys is that before you look at the hard numbers, before you go left brain, make sure that you activate the right brain, because both of them work together with the CFO and everybody else.
Love that.
That's very interesting. Of course, with a hat tip to Peter Drucker, who coined that expression. That's right. Culture eats strategy for breakfast. Very well put. Jennifer, how about you? How do you look at this problem or this challenge?
So how do I engage with the CFO? The CFO is my boss, so I try to engage in the best possible way.
Respectfully, I'm sure.
Yes. And with all the tools that I have at hand. But in all seriousness, what I think is that from a sustainability perspective, there's something to say if you think about financially, sustainability being about risk mitigation and operational efficiency. But as we all mature and understand how regulation is kicking in, the real opportunity for sustainability comes from innovation and growth and technology. And so I think that for me, if you think about ESG as an input into strategy and really sustainability being the outcome, how does business look like in a way when you think about not just financial capital and you understand that you're managing other capitals, natural capital, social capital, manufactured capital, and with that, with inputs and outputs, understanding what success looks like. So for me, the way that I engage and the reason why I report to the CFO is because when we think about financial performance and non-financial performance, you need to understand that, I guess, and I really believe it as a pre-financial, because the outputs and the outcomes and the impact come a little bit later, but nonetheless, it needs to be part of your long-term strategy. And so any CFO that is really business savvy will want to really understand not just how is it that it's going to talk about earnings on a quarterly basis, but really how is it that you engage, especially with a portion of investors, institutional investors that are there for the longer term. How is the company understanding future risks? Climate change is impacting everyone. Your ability to adapt, to invest in technology, to understand the financial risks that all of these systemic issues will have only speaks about a business that is savvy and that is understanding how the world is changing and how they need to perform. So I don't think sustainability follows really a separate track. It needs to be part of your business strategy. And as a CSO, your role needs to be as articulate and eloquent to explain why this is the right thing to do, but also why is it good to your business? Because you need to redefine how business looks like in a way that respects environmental and social boundaries.
Now, you've done something interesting at your company. You've created a sustainability index, if I'm not mistaken, that puts together a number of these things. Can you tell us a little bit about that, including, I think you explicitly link executive compensation in there to sustainability, am I right?
That's
so
right.
tell us a little bit about that. That's a hot button issue, obviously.
So Indeed. So 30% of our long-term comp is linked to ESG performance or sustainability performance.
30%.
That's right.
Wow, that's quite a lot.
But the thing is that it's not really big part of your long-term comp is linked to sustainability, because sustainability is our business strategy. So how is our sustainability index composed is very linked to materiality, which I believe any company should be following. So which are those issues that are really relevant, both from an inward perspective, so financially material to organization, from an outward perspective, how is it that we're impacting, and accordingly how they are calibrated so that the organization can be rewarded for performing. So concretely, what do I mean by that? I work for PMI. So PMI is a tobacco company traditionally. You may know it or not. Success used to come from making and selling cigarettes. This is not sustainable. It's not sustainable, and this is our most pressing negative externality. So naturally, when I talk about sustainability, our most material issue comes from the health impacts of the products that we sell. And the priority of our strategy, our business strategy, our transformation strategy, and our sustainability strategy that are the same, are to transform our company so that success is no longer based on making or selling cigarettes. So if you look at our sustainability index, the index has metrics that measure transformation growth. How is it that the company is shifting resources, and how executives and the organization is being rewarded in the long term to actually succeed in that shift, in that transformation. Now, when you think about transformation, when you think about transition, it's not just about changing one product for another. It's really about transforming the entire value chain. And so when you think about that, you think about other forms of impact, like impact on the environment, impact on society. This is a company that has 70,000 employees present in more than 160 countries. So naturally, inevitably, there's a huge footprint that we need to be mindful of and put initiatives in place that mitigate this negative impact. And so in a very coherent way, in a very consistent way, these metrics don't contradict business strategy, you see? And so the way that the organization is structured is that there's no need to sacrifice or redirect an individual or a function to say, I want to perform pro-sustainability, but this will hinder my business acumen, because it's really the same thing. And when it's the same thing, then 30% of your sustainability performance is also 30% of your business performance.
Yeah. Love that.
It's very interesting. And you made in passing the reference to sustainability of your historically principal product, tobacco. Now you're one, ultimately see yourselves as getting off of cigarettes.
That's right.
It's often made the comparison big oil to big tobacco. Do you see, for obvious reasons, do you see that analogy where as something that works, and maybe that the oil companies could learn something, having gone before them in this journey that your industry has learned?
Yeah, and actually this morning, I don't know if anybody was there, we had a roundtable with stakeholders from the finance sector, and for me this is a great parallel, because if you think about transformation and the need for transformation in order to affect systems change and issues that are affecting all of us, yes, there's more than 1 billion people smoking cigarettes today, and it's important to phase out cigarettes to address the health impacts these create. Equally important is to address inequality or address climate change, and fossil fuels and moving to renewables is an important part of that. For me, I think that something that we do is that besides reporting on traditional quote-unquote ESG metrics, we have this set of bespoke KPIs that we call business transformation metrics. And they really measure transformation. So there are a set of financial and non-financial KPIs that measure CapEx allocation, R&D spend, revenues that are deriving from new products. So if you think about energy, you could have energy in a very transparent way, report on the same. What portion of your revenues comes from renewable? How much is your R&D spend into renewables? How much is your CapEx allocation, users? How many consumers? Because that not only informs the way that you engage with investors, the way that you engage with civil society, it also informs regulation, and it also informs, in the end, policy is what shapes regulation, right?
Right.
And policy needs to be informed by data and by science, and what a great source of information when you have companies saying, well, we're investing X amount in R&D so that we can shift as fast as possible. Why is it not happening? So what kind of supply and demand measures do you need to put in place place, whoever you are as a stakeholder, in order to create this kind of change, you know? Because it's too complex to assume that one stakeholder in silo can affect the kind of change that we're all seeking. So the more information and relevant data you have, the more informed decisions you can make to actually shape change in the right direction and accelerate the pace of change, I believe.
Yeah.
Did you want to jump in on that?
Please, because I love what Jenny's saying there, about particularly about like supply chains, and there's nothing CFOs like better than efficient supply chains, because an awful lot of the reality around where we are with ESG generally and carbon specifically is the rubber is hitting the road in procurement and procurement policies. You know, I said to a group of chief procurement officers last week, finally it's their time, you know, in the middle of it all. But the key point is that to Jenny's point, that no one individual company can do this alone. It's a simple fact that over 90% of most companies' emissions sit within their scope 3, their supply chain. And there is huge opportunity, yes, to collaborate together and, telling it like it is, share the cost of reduction and transition together, but also to create business opportunity together. And I think that, you know, I talk a lot about, in different contexts, about how we need both chief sustainability officers and chief financial officers to collaborate with their peers outside their boundaries of their own companies, because the type of convergence, I guess, that we all need to see across industries and across supply chains and, yes, across ecosystems, no one company or even no single industry is going to do that alone. And I think that is fundamentally, like we're sitting here in the UK, like the UK has got such a huge problem of productivity. You know, these are the kind of initiatives, and innovation is going to help solve that productivity challenge, because it is about growth and the shift of markets and the evolution of the national and like the regional and of course the geo world economy. I'm going to stop there because I can get a bit of hobby horse about this topic.
No, that's all right. That's all right. Yeah, no.
If I may add on,
please join
Scope
in.
3.
Go ahead,
Scope 3 in particular, I think that's because you mentioned the opportunity, and I mean, all of us are now kind of grappling with that question of Scope 3.
Yeah.
One caveat, which has definitely been our experience, is with Scope 3, obviously, there's a massive data issue, and the reality is the better the data is and the better the quality of the data is, the worse your performance will be. And that's the reality of it. And therefore, there are implications. I mean, we're seeing, just taking it back to green financing and also ESG ratings, we're seeing that some lenders are asking us to set Scope 3 KPIs, for example, which I've never seen before. So definitely, even from a financial services perspective, it's becoming a key focus for that sector. If the CFO is not part of that journey, you're having to have really difficult conversations, because you're having to rebase all the time.
Yes.
At least once a year, you're going to have to rebase the target and the baseline, and that impacts access to capital, that impacts your ESG ratings. And taking the CFO as part of that journey from the beginning is absolutely key. We definitely have seen, at least from peers in the space, they've learned that lesson the hard way, because they're finding out that, for example, a certain lender has a particular threshold of ESG ratings that have to be met in order to include the company as part of their portfolio. If you're not meeting that, they'll drop you, and that literally impacts your access to capital. So that would be the one thing that I definitely would say is absolutely key, is taking your CFO really early in the journey of Scope 3 reduction and planning, and making sure they understand that it's an evolving science. The data issue is real, and it's going to evolve, and therefore having to rebase the targets is just going to be a fact of life, which ultimately impacts access to capital.
There's something related to this. I wanted to tie back into a point that you were making there, Jennifer, about one of the things in your index, which was executive compensation. I heard some murmurs from the crowd and smiles from the stage when you mentioned this. I think it is a hot button topic. Let me ask, a show of hands, how many of you are at companies where executive compensation is in any way tied to some form of sustainability performance metrics? Wow, well, look at that. That's easily well over half, maybe 60, 70% of our audience. And on stage, did I see a couple of hands go up too? No.
I'm just going to push back on that a little.
Well, it's just a question. Well, okay, what's your pushback? What do you find offensive about my question? I haven't even gotten to my question for the panel yet, but go on.
He's on it.
Okay,
Go on. You're annoyed that I would ask such a question.
I can see it coming, and the point I want to make is that an organization where the CEO has delivered outstanding financial performance is very unlikely to penalize him because he missed his carbon emission reduction target. Show me this organization, I want to be convinced. So that's the number one thing I want to say.
Okay.
I'd rather be the skeptics in the room. Second thing I want to say is that sustainability is about doing. So our entire conversation should be about how do we enable the delivery of more doing within the business. And we speak about the CSO maturity and fluency and commercials and so forth. Our obligation is to understand the language of our CFO and to feed him every other day with initiatives that will deliver direct bottom line benefits to the business. Because in the time when we've done integrated reporting, we've done natural capital, but in the time when there is economic headwinds and the profits are dwindling and the board is going to get together to put a restructuring plan together, I guarantee you that the likeliness that sustainability is saved if it's not directly linked to financial value creation is very low. I'd love to believe in a world where our life-saving purpose takes over the financial priorities, but I'm still, personally, after 20 years doing it, the skeptics in the room. So I just want to recalibrate that. Okay. And this is what the question that you asked us triggered. I just wanted to share it with you.
Yeah. Well, thank you. I'm going to add on a dose of skepticism from an expert in the area and then ask for responses and indeed any pushback that we might get. So there was an important article that Professor Lucian Bebchuk of Harvard Law School wrote that looked at this question of linking executive performance, executive pay, to the performance of these sustainability indices. And he and his co-author argued with lots of evidence and analytical frameworks that there's very little evidence that this is actually rewarding performance. On the contrary, they argued, and again, take it for what it's worth, it's an influential expert in the field of executive compensation, that this is an excuse for CEOs and C-suite officers to pad their pay with questionable metrics. To your point about how the metrics are rebased every year and things change a lot, that this is too easy to game, is to summarize their argument.
Can I say something about that? Me.
Please, so tell me what 30%.
So I think that
30%.
I read that.
You did. Excellent.
First, I think that the sample size was questionable. No one asked me, but it's okay.
No, I love it. Okay, go on.
No, not that it matters, but I do think that the sample was quite small. I tend to agree, and I have seen it, that the effort of linking non-financial performance to compensation, because sustainability KPIs tend to be very qualitative. It's difficult to measure, it's difficult to audit, it's difficult to verify, and so you end up with a board sitting around a table in a very discretionary and arbitrary way, saying kind of like, well, they tried, and A for effort, kind of. But and for me, that was very important in putting the index in place. And what we have done, and I am not saying by any means that this is like the way to do it, but mindful of these pain points, we created standards that replicate financial standards and are publicly available. What do I mean by that? Standards that are that have definitions, that have assumptions, that have publicly established methodologies. When the standards and the frameworks exist externally, we rely on them, not just on sustainability standards, but IMF, World Bank, etc. And we define glide paths like you would with financial performance to predefine how success would look like in a measurable, objective, verifiable way that eventually is externally audited. That's the first part of that criticism. So can you do it in a very wobbly, relaxed way? Sure. But I do think that for any company that is serious about sustainability, when you're linking this, I mean, a public listed company, this is in our proxy statement, it will be externally audited and needs to be verified. That's the first part. And the second part is, this really boils down to materiality. If you're just linking random KPIs of sustainability that are easy to achieve or easy to measure, naturally, they will disappear the moment that there's pressure on the business. But when sustainability is your business strategy, and this is really connected to your bottom line, there's no tension because this is the same thing. So the fact that the company is shifting to renewable energy to fuel the manufacturing side because the cost of energy is increasing and investing in technology is not in exchange of sacrificing the business, is business savvy. And so when the business starts to understand, and this is David's point about culture, the more that the business understands what sustainability is, the more educated the organization is, the more they embed it in their strategic thinking. The more it goes into your planning, the more it goes into your budget, the more it gets into your inputs, the more it becomes really part of your strategy. And so I would beg anyone who really thinks about rewarding ESG performance and linking it to comp to think about it in a serious and unstructured way. When it's linked to strategy, then A, there's no contradiction, and B, it needs to be as structured and as robust as financial performance would be measured.
Thank you. I can tell there are others on the panel that want to jump in on this.
Very strong views on that.
Let's hear it. Let's hear
I'm going to make a general point and a very specific point. So the general point is, from when we talk at ESG level, absolutely there's huge opportunity for, and I love Jenny's point, A for effort. But this is why generally the market is moving away from talking about anything to do with ESG generally to doubling down on carbon, because carbon is regulated and carbon is it's quantifiable, and also it's easy to bake in progress in the context of real reduction. Yeah, that's from across our customer base, across our ecosystem. And then a very specific point, as somebody who sits on listed remuneration committees and audit committees, I know how seriously this is being approached within listed boardrooms, and I know, having signed off some of those comp plans for listed CEOs and CFOs, and we have, the ones I've been involved with, and it's in the public domain, so appropriate to talk about, we have focused on carbon and the reduction on carbon, and a significant percentage of the CEO and CFO comp is linked to that, and I would see that mirrored across the board. So I think when we talk about executive pay and we talk about metrics, for me it's the same as any other performance criteria. I would not let any performance metrics be fluffy, linked to comp, and particularly variable comp, bonuses or LTIP. So therefore it is really important to make a distinction.
Comps, measurable, transparent,
and also we got to get real on segmenting ESG.
Right.
The morass of ESG is helpful to no one now.
Right.
It's important that we talk about things that are quantifiable, and carbon is one of those things.
All right. We have, as if that question weren't provocative enough.
We
have a question,
provocative. Keep going.
But I can tell my dream team here can handle this. This is an extremely rude question for you all, coming from an anonymous, what I can only suspect is a CFO in the room. It says, and you'll see what I mean when I ask this question. Let's see here. Oh, it's actually slipped off the screen. But here was the gist of the question. Do you believe that CSOs lack the commercial acumen to influence the C-suite?
On you go, you three.
So,
I'm going to go
like
with
I say, someone who's keeping their hand very low is typing in their phone in their Slido.
I love this question, whoever asked
I'm surrounded by bozos. I have to put up with you all. Right? So how do you answer this question?
I completely agree with that.
Okay.
This is
Wait, did he reach for his phone? Maybe you asked the question. Okay, let's.
It is like clearly a deficit from the sustainability practice. It's like you refuse to engage directly into the commercial outcome, and that until we do that in a radical and disciplined way, we won't access the full scale of the transformation we need to achieve. And everybody today is talking about money. The conversation has shifted so much from the right thing to do to how do we make money out of it? What is the investment required? What are the maturity of the solutions? What is the adoption of the market? How do we access the right level of financing? It's all about money. And tell you what I'm doing, guys. I'm doing now an MBA at Oxford University because I want to build up my commercials and finance. And I think that every CSO should do it in the same way that every CFO should go through the structured and learning about sustainability, because sustainability is also a discipline. You do not invent yourself as a sustainability leader, and the same way, well, you don't invent yourself as a finance leader. Both of them need to work together, and both of them need to be educated about the other side of what they have to deliver. So that's why, and I'm sorry for being passionate.
All right, yeah.
Don't apologize.
That's my answer to that question. Whoever asked.
Exactly. So go get your MBA. There we go. All right, he's outed himself now. Any other perspectives on this?
I mean, I can add a perspective in terms of like, it's not just as CSOs, but also even when it comes to the question of green skills within the organization. I'm pretty sure this is a challenge many CSOs face in the audience. When you're trying to hire for sustainability-related roles within the organization, it's literally like trying to hire a unicorn, because you're trying to find someone who is really good on the sustainability side of things, but also bring in really strong commercial acumen. That's very hard to find. And if you yourself don't have that commercial acumen figured out, it's going to be very difficult for you to guide the organization as to what green skills and green jobs look like as the company transitions into a greener way of making money. And so definitely, I mean, yeah, great question, definitely agree.
And I'd say final point on this is that I would say that I see it as a reflection of the growing maturity of the space. Anyone who was around, like when the chief digital transformation officer was a big hoo-ha in the enterprise, advocating everywhere, but with no fiduciary or P&L responsibility, wrecking the heads of everybody else.
Right.
Like, I think this is also what's happening, because now those chief digital officer roles have grown up into like the CTO, the most transformative market-making CTOs in the market. Right. I see the exact same happening with sustainability. Now, they're rocking around, chatting to everybody about the planet about like 8 years ago, whereas now they're in there, you know, preparing for annual reporting, because we're touching the core P&L, and I see that as high fives for the planet, and even bigger high fives for one's individual relevance for your future career.
Well, I can think of no better way to end this session than that inspirational note of CSOs rocketing and telling the CFOs what to do. So let's give our panel a nice round of applause. Thank you.